Right, Assalamualaikum and good afternoon. So again, for this week, we are going to continue with our lectures. Hopefully, I can cover two topics if possible, or else just focus on one. So we will start with topic number 8. Okay, topic number 8, which is risk and return. Okay, give me 1 second. Okay, sorry about that. So the topic of risk and return is actually very important when we talk about investment decisions. So the concept of risk and return very much applicable when we try to do a portfolio of our investment. And basically, when we do portfolio of investment, we are trying to reduce our risk. Anyway, let's look at the content. So first, we're gonna look at the return side. Okay, the return side of this topic. As you can see earlier, kita ada return and also risk. Okay, so first we're going to look at the return, and obviously later on you will see for both return and risk, we can try to calculate based on individual investments or in a portfolio of investment. Okay, so again, what I mean by portfolio investment, which is a pool or a selection of investment, right? So So what is return? It's all about return refers to the rewards for investment or the benefits that one investor expects to receive over some period of time. So here we can see there are two types of returns. Okay, the two types of return. The first one is known as income return. Okay, income return. So when we talk about income return from investment, usually we can associate with the types of return that our investment will generate. Okay, we generate usually at the end of one year period. Okay, for example, here dividend. Here dividend number one. Or if you invest in bond, for example, the income return is in the form of interest. Yes, for dividend, investment trust or your investment in shares, for example, will give you dividends. But for interest, for example, can come from bond investment. And if you invest in property, your return might come from rental. Okay, monthly rental. So this is from property. Okay, so all of these are considered under the income return section. Okay, the type of returns which are generated from your investment. Okay, that's number one. The second component of returns is from the capital gain. Okay, first study income return or income gain. Second is the capital gain. So the capital gain comes from the changes okay, in terms of prices of your assets. So basically, the difference between purchase price and current price. Current, or sometimes we just call them market price. Okay, as simple as you purchase one stock at RM. For example, your purchase price. And now the price of the stock increased to RM1.50. So this is the market price. Okay, so you see the difference of 50 cents. That is the capital gain. Okay, so whatever the changes of price between the purchase and also the current price will be your capital gain. Sometimes we call them as capital appreciation. Okay, so appreciation is the opposite of depreciation. Kalau depreciate, the value dropped, but for appreciation, the value is increased. Okay, so that's the second types of returns. So as an investor, okay, you are hoping to get both, okay, both returns. But obviously for capital gain, this is only applicable to you, okay, if you decided to sell them. So meaning, like for example, tadi, you purchases, let's say 10 lots of stocks for RM1 each. Okay, but now the price increased to 150. Okay, the 50 cents difference, though, the capital gain, you will only actualize it, you will only earn it if you decided to sell. Okay, so if you don't sell it, okay, so it just be on papers only. This capital gain will only appear on paper, not will be actualized. We call them actualizer. Actualize. So you will only actualize it if you decided to sell capital gain, or only profits or gain on papers. Okay, but for income return, you will receive the cash. Okay, in terms of the dividends, in terms of interest, rental, everything will be transferred to you. Okay, but for capital gain, this is only appear on paper at first. Unless you decided to sell them, then you will receive your profits from your capital gain. Okay, so that's the difference also in terms of the income versus capital gain. Okay, so here one example. You purchase 1,000 shares. Okay, 1,000 shares, and I think I've discussed this in stock valuation before. When we invest in stocks, okay, in Malaysia, we trade in lot basis. Okay, lot basis. And in Malaysia, one lot, okay, equals to 100 units. Okay, one lot equivalent to 100 units. So if this person purchased 1,000 shares, it means, okay, 1,000 divided by 100, you can find that this person purchased 10 lots, okay, 10 lots of stock A. Okay, or in total 1,000 shares. Okay, 1,000 shares. And this is the cost, RM5.80. So they purchase at 580 per share. And after 1 year, you sold them for 660. Okay, RM6.60. So the keyword here is sold. So meaning you actualize it. You actualize. So meaning you dispose your shares in this case. Okay, at 660. So here you can see the difference is your capital gain, 80 cents. And on top of that, you also receive a cash dividend. So this is the income gain, okay, which is 30 cents per share. Okay, during the same period, which is 1 year. So first question, how much is the capital gain again? Remember, the capital gain refers to the price appreciation. So from 580 to 660 is 80 cents different. Okay, the difference is 80 cents multiplied with 1,000 shares. So this person received RM800 capital gain. Okay, and on top of that, in terms of the dividend returns, okay, dividend, they receive 30 cents per share. So 30 cents divided by 1,000. This person received RM300 in terms of income returns. Okay, so in total, okay, the return is equivalent to 1,100 ringgit. Okay, so this is the composition of returns from income versus capital gain. Okay, and I recap, for capital gain especially, you will only can get this 800 ringgit if you decided to sell them. Okay, if you don't sell, or if you don't sell your stocks, okay, this 800 ringgit again is just appear on paper only. Okay, you have 800 unrealized profit. Okay, kalau tak jual lagi, kita panggil dia unrealized profit. Okay, the keyword of realized ataupun actualized tadi. Okay, so that's part of returns. Okay, so from risk point of view, okay, we haven't touched about the measurement of return yet. This just give you the idea of what is return is all about. And when we talk about risk refers to the uncertainty. Okay, uncertainty of the outcomes of investment. Obviously, majority of investment will have the element of risk. Okay, the uncertainty. There's no majority lah, I can say, unless it is a guaranteed types of investment. Okay, which is usually will offer you a very minimum returns. Okay, so risky assets or risky investment will give you slightly higher types of returns. So there are many possible variation of returns from investment due to this uncertainty. So obviously, due to the possibility of uncertainties, obviously your possible returns also will vary from one situation to another. Okay, so the measurement of risk, we can use what we call the probability, okay, which is the variation or the likelihood of an outcome. Okay, so the larger the variation, the larger the probability indicates the higher risk. And there are some of probabilities must be equivalent to 1.0. Okay, the sum. So if you have a few variations or a few probabilities, the combination of all values should give you an equal of 1 or 100% lah in total. Yeah, I'll show you afterwards what does it mean by probabilities. Maybe I can explain a bit guys. So let's say, okay, if you want to do some analysis, you have three probabilities of the situation, of the economy situation. For example, optimistic, for example. This is the first probability, optimistic situation, normal situation. The third one, pessimistic, for example. So we have three probabilities of our current economic situation. Optimistic means it's a good condition, very, very optimistic ataupun we are very determined, we are very confident with the situation. Okay, optimistic. Normal means in a normal case scenario. Okay, pessimistic means if we are not really hoping for the best, and this is usually during the bad time of the economy. Okay, so out of these three possibilities, we can put some weightage. Okay, some weightage of this. For example, for optimistic, maybe the chances this to happen maybe around 20% only. Okay, 20%. And the highest weightage would be here. Let's say 60%. It will be in a normal situation. And worst case scenario, we're going to put 20% also here. So this would be the probabilities of the three situations. And combination of these three, 20 plus 60 plus 80, will give you a total of 1. It must give you total value of 1. Okay, but for your case, you don't have to worry about this. Usually this will be part of your question. The question will give you three scenarios with a total of 1 or 100%. With the three different weightage of probabilities. Okay, the higher the probabilities indicates that's the highest chance this situation will happen. And this risk, if we compare against the return, we can use the risk of expected returns. Okay, so this risk refers to the uncertainty of investment. Okay, should reflect the degree of the uncertainty. And the risk of expected return reflect the degree of uncertainty that actual return will be different from the expected return. Okay, so this is one of the measurement. I will show you afterwards how to calculate the expected returns. And in short, the expected returns, we use the symbol ER. Okay, the expected return, we use the symbol ER. And this is the measurement for return when we take into consideration the risk factor. Okay, what are the risk factors? This factor, the probabilities. Okay, the probabilities. For the individual investment, so like I said, when we measure the risk, the return, there are two parts. First, if you look from individual, from single investment. Secondly, from a portfolio investment. Okay, meaning a pool or a set of investment. So first, we're going to look at individual first. Okay, single, for single investment. So the ER, the expected returns that we're going to use is based on this formula. Okay, which is the sum of probabilities versus the returns of the investment. So the formula for ER is P1 times R1. So P1 here refers to the probability. Okay, remember, like this one, this is the probability, the percentage, the weightage. And this weightage we need to multiply with the expected returns. Okay, expected returns of this probability. Okay, so this is one set plus the second probability multiplied with the respective returns for that particular probability. Okay, and regardless how many probability, we're going to end with Pn times Rn. So n here refers to the maximum returns ataupun the maximum probabilities and also returns. So if you have three like this, okay, optimistic, normal, and pessimistic, you're going to have P1 plus P2 plus P3. Okay, if you have if you have four probabilities, you're going to have four P's and four R's. Okay, so that's why I put triple dots here and P and Rn. So n here referring to the maximum numbers of probabilities and also your returns respectively. Okay, so example like this, we have three scenarios, just like what I've showed you earlier. So, but this scenario, they use the word worst case scenario, base case, and best case scenario. And the probabilities is 10%, 80%, and 10% respectively. And again, if you combine all, give you a total of 100%. Okay, 10 plus 80 plus 10 in a total of 100%. This probability must be 100% or 1.0. Okay, and we also have respective returns for the worst case, base case, and best case scenario. So what does it mean here? For this investment, for Nuco stock, during the best time, during the best economy, you can get up to 18% returns. Okay, in normal times, you're going to get 14%. And during bad time, during worst case scenario, you're going to get 10%. Okay, 10%. So obviously, the highest chance of the economic situation is based on base case scenario. So meaning, in majority of time, you're going to assume that the economy will be at the normal situation. Okay, 80% chance it happened. Okay, but there's a 10% chance each that the economy can go down or goes up. Right, so that's the probability for this stock. Okay, so to find the XER, the expected returns, based on this formula, okay, you can use this formula, or you can extend your ER kat sini, okay, by multiplying the probability and the return respectively. Okay, for example, so the first probability is 10% times 10%, so we have a 1% here. The second one is 80% times 14%. It's 11.2%. Okay, 80 times 14 is 11.2. And 10% times 18%, we have 1.8%. So if you combine all together, so because the formula is plus, you sum, P1 plus P2 plus P3 in this case, 1.8 plus 11.2 plus 1%. So you have a total of 14%. So this is the average, okay? This is the average or the expected returns for this investment based on 3 probabilities. And coincidentally, the ER is equivalent to the one in the base. Okay, not necessarily all the time ER must be in the middle, and not necessarily, but for this question, coincidentally, yeah, it's 14%. Okay, most likely because of the higher weightage of 80% here. Okay, that give them quite dominant figures here, 40%. Okay, so this is how we calculate the ER. Or if you want to use a formula, be something like this: ER equals to 10% times percent plus 80% times 14% plus another 10% times 18%. Okay, all of this respectively. So give you 10%. So it's up to you to use in the form of this formula to get the 40%, or you can use the table. Okay, extend one more column and simply multiply for respective probabilities and the returns. Then you get the sum of all to get the ER. Okay, so this is the measurement of returns, expected returns, for one single investment, which is in this case is based on this Newco stock. Okay, one stock only, Newcos. Okay, but if you have 2 or 3 stocks, so meaning you need to measure each and individual of stocks independently. Okay, so this is our first example based on ER, very straightforward. Okay, if you have any questions, just let me know. So the formula is based on this. You have 2 ways to display how to calculate it using this formula, or you can use this table. Right, both will give you the same answer anyway. So this is the measurement of returns. Okay, remember for single investment. So now we're going to move on to the single measurement for risk. Okay, for risk. So for the measurement of risk, we're going to use variance and also standard deviation. Okay, so we're going to measure variance and standard deviation. Again, this is based on individual investment, single investment. Okay, and this variance and standard deviation indicates that the higher the values for variance and standard deviation, the higher the risk. Okay, so therefore, if we want to manage our risk, we want to have a very minimal variance or standard deviation. Okay, so how to measure the variance? Okay, variance can be symbolized using the sigma squared. Okay, this is sigma, symbol of sigma squared. Okay, to the power of 2 squared. So the formula is the sum of Pn. So similar like before, we're going to use the probability like this, probability, and we multiply this probability with the difference of returns minus the ER. Okay, so Rn here refers to this original value, and ER is based on this ER, 14%. In this case, if you use this example, this is your Rn, returns for worst case scenario, and we minus this 10% with the ER, okay, 40%. Okay, 40%. And the difference, we have to square it first. Okay, difference, okay, minus, okay, the returns minus the ER, square, okay, and multiply with the probability. Okay, probability of respective difference. Okay, so the sum of means similar like this. You're gonna sum everything back. Okay, so that's variance. And to find standard deviation, simply square root your variance. Okay, because the standard deviation is symbolized using the sigma sign. Kalau tadi sigma squared variance, so standard deviation is sigma. So in order to change from sigma squared to just sigma, what we need to do is to square root the sigma squared, or to square root the variance. So whatever variance you get, you just square root the answer. Okay, square root the answer. Okay, using the same example. Okay, using the same example, and we already calculated our ER earlier, which is 14%. So this is our ER. Okay, this is our ER. So to find variance, for example, we want to find variance now. Remember the formula is, okay, the probability, which is in this case 10, 80, and 10% respectively, multiply with the difference of 10 minus 14 squared. So meaning if I put a full formula first here, it's 10%. Multiply with the difference, so it's 10% minus 14% square. Okay, which is this part, probability times the difference of Rn minus Er square. This part. So 10 minus 14 is 4, negative 4 square, 16 times 0.1. So you have 1.6 here. Okay, so we're going to measure for all three. So here it will be 80%, 14 minus 14 squared. Okay, 14 minus 14 is going to be 0, squared also 0, times 1, it's going to be 0. So it's going to be 0. In the middle, it will be 0. Okay, 0 variance. Okay, no risk whatsoever for this case, because the chances is too high in this case. And lastly, it's 0.1. 18 minus 14 squared. So another 4%, 16, which is 1.6. So altogether, we have 3.2. Okay, 3.2. This is the variance. The variance of the stock, new full stock, 3.2. Okay, and you don't put it a percentage for variance. The answer is not in percentage. Unless you want to get it in percentage, you have to divide this by 100. Okay, or else you just put it 3.2. But for standard deviation, okay, you're gonna square root 3.2. You're gonna get 1.79. 79. And this 1.79, you can put the percentage. Okay, this is 1.79%. Okay, 1.79%. So it's close to 0, meaning this investment has a very low risk. Okay, very low risk for this standard deviation.
Doctor,
Yeah,
because of we are using percentage, so what if I use decimal instead of percentage, like
decimal. You don't use
10%?
decimal.
Oh, we need to use percentage, not decimal. Like,
Which one?
I
Standard
mean,
deviation.
the calculation.
Here,
Uh-huh. The calculation. We need to
which
calculate
calculation?
it in
Yang 10 minus
percentage.
40 ni.
I mean, all
Or
the
you put
calculations.
0.1 minus 0.14.
Yeah. I do like that. Is it alright, or I
Mm,
cannot use that one?
it's okay as long as you get the same answer. That's why for
Uh,
me, usually the probabilities I use decimals. But in terms of the returns, I'm going to use the full values. Okay, so the
okay,
probability I'm going to
okay,
use the
doctor.
decimal. Okay, but the returns I'm going to use full values, 10 minus 14 and so on. It's possible to use 0.1 because mathematically it's correct, but I'm not sure whether when you're using your calculators, there might be some decimal errors, perhaps, if you don't use it consistently. Okay, and for my advice, what I'm gonna do ataupun what most of the time I do is based on probability. Yes, I use decimal like this, okay, 0.1, 0.8, 0.1. But in terms of the returns, I'm gonna use the full values. I just keep the percent here. Okay, so this is how we measure the variance and the standard deviation. Again, this variance, I use the table. Remember, I use this table to help me to get this answer, or else you can use this format as well. So me, for this format, it will be slightly longer lah. Your variance will be 0.1 multiply with 10 minus 14 squared, k plus 0.8, okay, and so on lah. So you gotta repeat everything, and you get at the end 3.2, for example. Okay, and for the standard deviation, you can use just this formula because the formula is very straightforward. It's the square root of standard deviation. All right, so that's the measurement for single investment. Okay, for ER, earlier we calculated ER. Then we have variance and also standard deviation. Okay, this is for single investment. On top of that, we also can measure what we call as coefficient of variation, or CV. Okay, this is a statistical measure of dispersion of data points in a data series. And basically, when we talk about CV, we just want to see how dispersed the variation, okay, between the mean. So imagine this one line here refers to the average, the mean. So we want to see how dispersed, how wide the changes. Okay, so again, the measurement is based on CV, coefficient of variation. So the formula is standard deviation. Okay, standard deviation divided by the ER. So both we have already calculated earlier. Okay, for this example, our standard deviation is 1.79 and the ER is 14%. Based on previous example, 1.79 divided by 14%. So here you're going to get about 12.78%. Okay, 12.75%. That's the measurement of coefficient of variation, or CV. Okay, again, this is just based on one single investment. Okay, one single investment. So the higher the CV, again, the higher the range. The variation too will be huge. So when we talk about huge variation, obviously more risk involved because we cannot predict how high or how low it will drop. Okay, so for investor, usually we're gonna invest in something yang we can predict within the mean, or even the price or the average goes up. Like this is just I wrote in one flat line. In trend, there's a possibility of increasing trend, or it can possibly in decreasing trend. Okay, whatever it is. Okay, when we talk about low CV, it will revolve slightly just above the line. Okay, not like this, which is high and lows. Right. So that's the first part. We have four. We have ER, variance, standard deviation, and also CV, coefficient of variation. Okay, you don't have to calculate all. It's all depends on the question. Okay, most likely they will ask you the ER, the variance, and standard deviation. Okay, for individual investment or individual stocks. Okay, but now we move on to multiple investment. Okay, multiple investment or multiple assets. So one of the measurement here is to measure the covariance. Okay, the word co here refers we want to measure the variance, but how they react between two assets. Okay, they relate together. So meaning we want to see how these two assets, if you have two investment here, how they behave one and another. Behave here, it means if there's any relationship when one stock move, either goes up or goes down with the other investment. Okay, this is what we call as covariance. Okay, so this covariance measurement will give us indication. Okay, there are three possibilities when we talk about covariance. The first one, if it's positive, when we measure the covariance and you get a positive values, for example. So if that's the case, it indicates that these two investment or these two stocks, okay, will move in the same direction. Meaning if one stock goes up in terms of price, for example, the other one will goes up in terms of price as well. Okay, that's positive. And when I said positive, it doesn't necessarily means when they increase only. When they reduce, also will move in the same direction. Means, let's say stock A reduce in price. If they are positive covariance, it means for stock B, it will reduce in price as well. Okay, so goes up and goes down together in the same direction. Okay, the same direction. If they have a positive covariance. Okay, here example, if two assets have a covariance of 0.5, so they will move in the same direction. It might not be at the same weight, but they will move at the same direction whatsoever. Second possibility, the covariance will have a negative values. Negative. So for negative, they will move in the opposite direction. Or sometimes we just call them as an inverse relationship. They move the opposite. So meaning if one stock goes up, the other one will goes down, and vice versa. Okay, they will not move into the same direction. Okay, that is negative. Still have relationship set negative covariance. They have somehow related, but they move in different direction. And lastly, the third possible situation, if the covariance is equal to exactly 0, even 0.01, we can find a positive covariance. Okay, we put two decimals. If we have 0.00, then it means we have zero relationship, meaning there will be no relationship between the two assets. Meaning they are the two assets that we have is independent from each other. They move in a very the movement. There's no relationship at all. Okay, so that's covariance of 0. So by measuring this covariance, we can determine or identify our assets relationship. Okay, so to calculate the covariance, okay, so obviously we need to, as earlier with the chart and the variance, the separation, we just have one asset A, for example. But for this covariance, we need to have two. Okay, at least two. Most of the time, we have two. Here, A, asset B. So the first bracket here refers to the first asset, and the second bracket refers to the second asset. And if you see this formula closely, it's pretty much like variance formula. Need variance. We still have the probabilities, and we have the difference of return minus the ER. Okay, but minus the or without the square. We have return minus the ER without the square, but we multiply with the difference of the second assets, return for second asset minus the ER for second asset. And we're going to have the probabilities as well. Okay, so the S ataupun the S here refers to the different states of the what we've done earlier. But for this covariance, okay, we cannot use the earlier example lah, because based on the earlier example, we just focus only on one new code. stocks, one asset. Okay, but now we have example, we have two assets, asset A and asset B. So this is a totally different question. Okay, we have two assets, okay, A and B. And again, if you combine, if you total up the probabilities, 20 plus 55 plus 25, give you a total of 10. Now, okay, but now we don't have the ER yet. So therefore, we have to calculate our ER respectively. Okay, we have to calculate the ER respectively. Second. So the same measurement as before, right? So I will write the ER at the bottom here, just to indicate to you the ER at the bottom using the earlier example, the earlier formula. So 20% times 20% plus 55% times 14 plus 5% times 7%. So here I get 13.85%. Here the ER here. Okay, 13.85. Let me double check. 2 times 22 percent times 14 percent times 7. Here I get 13.85. For stock B, we have 2 times 6, 5 times 10%, 5% times 20%. So I have 9.7 here, 7%. Okay, these are the ERs for A and also B. So once we have this ER, okay, then we can calculate the covariance. Okay, because we have the returns and we have the respective ERs. Okay, so for your covariance, it's gonna look something like this. I try to write it line by line. So it's 50%. Okay, multiply with the difference. 22 minus 13.85 multiply with 6 minus 9.7. That is our first line. Okay, 20% multiply the difference. Okay, the difference of return A minus ER multiply with the return B minus ERB. Okay, that's our first line plus 55%. 14 13.5 10 9.7. Okay, please note we don't have square here. Both differences don't have square. When we did the variance earlier, okay, bear with me 1 second. When we did here variance, we square these values, the difference. Reason why we square, because we don't want variance to be negative. That's why we square. If we have a negative values in the bracket, when we square, we're going to get the positive values. Okay, but for covariance, we will not square it because there's a possibility of negative values. Remember, when we have variance, this indicates in a different direction, okay, opposite direction. So we don't square any of our values. So if we have, like, for example, for our first values here, it's a negative value here, so you just keep it negative here. Okay. And the third one is plus 25%. 7 minus 13.85 multiply with 12 minus 9.7. Okay, so please help me to get the total of this covariance. So solve line by line, so 20% or 0.2 times the difference times the second difference, then plus with the second line and the third line. What would be the total? covariance. Apa tak? Kan ada jawapan yang ni tadi. Okay, for my calculation, I get 9.95. Okay, negative, negative. We have a negative covariance in this case. Okay, so from this, pattern you can see, right? For example, if you focus on normal, for return A is 40%, return B is 10%. But during boom situation, so meaning during the best economic situation, they move in a different direction. Okay, for stock A, it becoming, higher. But for stock B, they are losing returns. Okay, they reduce. And vice versa when it's during recession. Okay, they move in a different direction. So therefore, it is expected to have a negative, negative values of covariance. And another measurements of covariance, the relationship, we can measure the correlation. Okay, similar like covariance, we want to measure how the two stocks behave and how they relate from one and another. However, for correlation, the score, okay, the score will range from a -1, okay, 0 will be in the middle, and the maximum will be +1. Okay, so the range of correlation will be within this here. So it can be 0.7, 0.8, or -0.9, for example. And at this range, this is a negative relationship. +1 is a very strong positive relationship. Or again, if it's 0, it will be no relationship at all. Okay, so this is the extension of the relationship formula. So we're going to use the covariance that we get earlier in the covariance. But now, in order to find the correlationship, we have to divide the covariance with the symbol sigma, sigma A times sigma B. So sigma here refers to standard deviation. Okay, so meaning standard deviation stock A times with standard deviation for stock B. Okay, since we don't calculate standard deviation here, we cannot calculate the correlation lah. But if you want to calculate the correlation for this example, first you need to find the variance, then find the standard deviation for respective A and B. Then we're going to divide in order to get the correlation of this example team. But my gut feeling saying that the correlation of this example 3 will be -1. Okay, -1.0, my gut feeling. Because it's a very strong relationship, indicates that they move in a different direction. Okay, so later you can try calculate how to calculate the correlation. So you have the covariance already, -9.95. So what you need to do is to find the standard deviation of A and standard deviation of B. Okay, but to indicate ataupun how to illustrate to you how to measure the correlation. So this is another example. Given our covariance is 18, what would be the correlation if A and B has a standard deviation of 8 and 4 respectively? So simply 18 covariance divided by SDA times SDB, 8 times 4. So we have 0.5625. Okay, so this is a positive, positive relationship. It means they have a strong relationship, quite strong ataupun mild relationship, 0.56. So kalau +1 tu exactly strong relationship, kalau 0.5 ni maknanya middle ataupun mild relationship. Okay. So that's correlation. Okay, correlation. And finally, okay, the final parts of our measurement, okay, would be the measurement of risk. Sorry, kita ada measurement of ER pun belum for this is basically transition. So I recap balik lah. For single instruments ataupun single investment, we have ER. This is for single. We have ER, and we have this is for and for risk, variance, standard deviation, also CV, coefficient of variation. And moving to ataupun more than one lah maknanya multiple assets. Okay. Before we do the multiple, we need to transition our measurement here by calculating the covariance and also correlation. Correlation. So we have two measurement, covariance and correlation. And when we measure the multiple assets afterwards, we're gonna revisit the ER. We're gonna visit the ER, and we're gonna revisit variance and also standard deviation again. So we have three measurements for the multiple assets. Okay, and in order to use ataupun to calculate the multiple assets, we need the transition punya formula, the relationship formula, especially this covariance. Okay, the covariance is really important. Okay. So for portfolio, first we're going to revisit the ER of portfolio. And the formula is quite similar like the original expected returns, but instead of using probabilities, okay, remember for the ER of single asset, we use P1 ataupun the first probability multiply with the returns. But for the ER of portfolio, okay, we're going to use the weights, the weightage of the portfolio. And the R here refers to the ER. Okay, we use the ER of the individual. So that's why in order to calculate the portfolio's measurements, either for ER, for variance, or even standard deviation, we need to have the original or the individual measurement first. Okay, the individual, the single, we have to calculate first, and the information that we have here, we're going to transfer to the multiple calculations. Okay, so for the ER of portfolio, we're going to use the weight, okay, the weight of the portfolio. Weight here refers to the values of that particular portfolio versus the overall portfolios. Okay, I'm going to show you afterwards. Okay, just imagine like this lah. We have two assets here, asset A and asset B. So when I set weights, okay, I want to know if I have 100,000 ringgit, this 100,000, how I split this 100,000, 60% here, for example, and 40% here. So meaning I invest 60,000 in stock A, 40,000 in stock B. And my weight would be 60-40 in that case. Okay, and that would be our weight, W. Okay, this is just a simple rough idea lah, how to get the weights. Okay, the values of our investment on any particular assets. Okay, usually when we talk about the question, they will give you like this. There's only two assets here for comparison. So you need to calculate individually, A and B. And for portfolio, we're going to combine for A and B as well. So we need to have the weights. So here, for example, nothing to do with the earlier example. This is standalone question. Assume an investment manager created a portfolio with stock A and B. Stock A, ER, is 20% with a weight of 30%, meaning from the total portfolio funds, they invest 30% in stock A. And for stock B, the ER is 15% and the weight is 70%. So meaning, again, if I have 100,000, 30,000 I put in stock A, 70,000 I put in stock B. So therefore, I have the weight of 30% and 70% respectively. So what would be the ER of portfolio? So the ER of portfolio would be, okay, I add the word portfolio here to differentiate the ER for individual and for the portfolio. So the weight for stock A is 30% and the ER is 20%. Okay, this is the ER. Okay, and I add with the second weight is 70% for stock B and the ER is 50%. Plus 7%. So I have a total of 16.5%. Okay. Remember, this is technically, when we talk about ER, this is basically an average. But it's not a simple average. This is more on the weighted average. We use the weight, okay, to get the average. If you use simple average, what we do, we just 20 plus 15 divided by 2. That's simple average. Okay. But we are using the weights. Okay, therefore this is known as weighted average. Similar like the probabilities earlier, the normal ER for individual. This is also a measurement of weighted average. Okay, so ER is basically the average of possible returns. Okay, of possible returns. So in this case, the ER of the portfolio is 16.5%. Okay, again, remember for this question, the 20 and 15% is given. Okay, but in your case, usually your ER, you need to calculate yourself like this one. You need to calculate the 13.85 and 9.7 yourself. Then we use the weights. So for example, katakanlah the weight is based on this 60-40 ratio. Okay, I give based on 60,000 invested in stock A, 40,000 invested in stock B. So therefore, if I convert this 60,000 and 40,000 into percentage, I get 60% and 40% respectively. So if I want to find the ER of portfolio of this example, if this question, with this example 60, my ER of portfolio would be, okay, 60% for stock A with the 13.85 of ER for stock A plus 40% weight for stock B with a 9.7 ER for stock B. For so here I get sorry, sikit yeah, again 6 times. Here I have the ER of 12.19%. 12.19%. That would be our ER portfolio. Okay, so this is ER for stock A. This is ER for this stock B. Okay, 13.85 and 9.7% respectively. But as a whole portfolio, if I invested 60 and 40 ratio, my ER portfolio would be 12.19%. Okay, the average between this stock A and stock B. So this is the concept of portfolio. So if I have 100,000 and I invest everything in stock A, I'm going to have expected return of 13.85%. But I have a certain risk involved for stock A, obviously, because I haven't calculated the variance and standard deviation here. I cannot show you how much is the risk. Okay, but for stock B, my expected return is 9.7, obviously lower than this, but I might have a slightly lower risk for this. Okay, but how to manage my funds by trying to get as high return as possible with a minimum risk. So I combine, okay, some of my investment I put in investment A, some I put in investment B in this ratio 60-40, for example. And by doing this, I minimize my return. Okay, I have to sacrifice my return. Instead of maximum of 30.85, I can get 12.19, but obviously higher than stock B alone. But I can reduce my risk. Okay, so this is the purpose of portfolio. Okay, because when we do portfolio, we minimize our risk with trying to get the intention to get the maximum return as possible. Okay, so that's the portfolio lah, the ER of portfolio. And finally, the portfolio variance. Okay, for this one, memang the formula is slightly long. Okay, this is the formula as a whole, but you can split it into 3 sections. Okay, if you ask me, I'm gonna split it in 3 sections. So this will be our first section. Okay, this would be our second section. And this will be our third section. So don't worry about the formula, right? Because it looks long, but it's actually few items. Okay, there's only few items. Okay, so in terms of variance, the explanation of variance and deviation is similar like before. Okay, this is measurement of risk. The higher the score, the higher the risk. Okay, so for the first section, this is actually the weights. Okay, remember this weights we have this question tadi 30-70. And in my earlier example, I put 60-40, so that's the weight. Okay, weight for stock A and weight for stock B. Okay, so weight, let's say if we use this example, so this would be 30%, 30% weight A, 70% weight B. So weight A, 30%, you need to square, okay, weight A square, multiply with this. Okay, this is sigma squared. Again, sigma squared refers to variance. Variance. Okay, variance of stock A. Okay, variance of stock A. That's it. This is actually weight A square times variance stock A. Okay, that's one section. Plus weight B square times variance stock B. Okay, plus, okay, 2. This is a fixed number, 2. Multiply with the weight A, multiply with weight B, times the covariance. So this is the covariance that we've calculated based on covariance formula. Okay, so that's why in our case of portfolio variance, we need to know the covariance, okay, the transition, etc. To know the relationship between the two stocks, we need to find the covariance, not the correlation, the covariance. Okay, so even though we might have a negative covariance here, remember our portfolio variance will give us a positive value. Okay, always positive value. So if you get a negative variance, you cannot calculate standard deviation. So therefore, you might have something wrong with your calculations. Your portfolio variance must be in positive values. Okay, even though you might have a negative covariance, because when you have these values at the back, even though it's negative, these two values in front usually will be higher than the ones in the bracket at the back. Okay, so you will get a positive values at the end. Okay, and to get the portfolio standard deviation, simply square root portfolio variance. Okay, simply square root the portfolio variance to get the portfolio standard deviation. Okay, here's some example lah. Okay, to give you a better look of this, the whole thing that I've shared with you earlier. Let's try one example. Okay, this is one typical question of risk and return. They're gonna give you at least three state of economy, good, normal, and poor. We have three probabilities. Okay, and we have two stocks. So in this case, they don't label A and B lah. They have names for it. Okay, but doesn't matter. We have two stocks here, 6AM and Motlak. Okay, so with the different returns for different states of economies. Okay, so this is your starting point. And the first question, states calculate. Okay, give me 1 second. Okay, calculate the ER, expected returns, and also the standard deviation for each stocks. So meaning you need to find the ER and standard deviation for both stocks S and M, 6AM and Motlak, the ER, and also the standard deviation. And as you all know, to find the standard deviation, you need to find the variance first. Okay. And then second parts, calculate the covariance and correlation. Okay, covariance and correlation. And third, find the ER and standard deviation of portfolio if they use 40-60 ratio. So this is your weight. Okay, 6AM 40%, Motlak is 60%. Okay, 40-60 ratio. So these are the weights. So you don't have to calculate lah. We have the weights already. So how to solve this? Okay, I'm going to show you one step by step. Okay. But before we go step by step lah, maybe I give you 5 minutes break lah, kejap okay, to digest. Okay, you take a look at this question. Kalau rajin, you can try. Okay, you can try to find the ER and standard deviation, but I'll give you 5 minutes break before I show you how to prepare all of this information required. Okay, ER and standard for individual, the covariance or correlation for the two stocks, and ER and standard deviation for the whole portfolio using this weightage. Okay, so I'm going to leave this page on so you can try to find the ER and standard deviation at least before we restart in 5 minutes time. Okay, take a 5 minutes break. Okay, so let's try to solve this question. Okay, let me adjust a bit so that I can see everything. So hopefully you can see, as always, the question will be on the left and I'll try to answer one on the right here. Okay, we have 3 states of economy. So maybe I'm just gonna use the formula instead of the table. Okay, so I'm gonna calculate the ER for S here is 6 a.m. 6 a.m. I use the word S as my initial. So it's gonna be 70% times 5. Okay, plus 20. So plus 10 or 20%. So 0.7 times 5 is 2 times 12 is 20. So anyway, if you have different answer, just let me know. So here I have 7.9. Count, check. Times 5 times 2 times 2 plus 7.9. So for ER of stock M, okay, it's gonna be again the same weightage ataupun the same probabilities, 0.7, but it's 40% plus 20%, 25, 10% for 7. So I have here 33.7%. Okay, 33.7%. Okay, let me try again. So technically, this would be our expected returns for the first and the second stocks. So far, even though the marks is 10, so far we have 4 marks for time being. For the ER, we have 4 marks. Next, we move on to the standard deviation. Okay, and in order to find the standard deviation, like I said, we can use the variance or you can use the standard deviation straight away because we need to square root our formula. Okay, or we can, okay, for me, I will still use the variance because we need both information by the way. So I'm going to put variance for S. So the formula would be the weightage ataupun the probability multiply with the difference. Okay, the difference. So for first, it's 5 minus 7.9. square, don't forget the square, plus 0.2 12 minus 7.9 square plus 0.1 20 minus 7.9 square. Okay, 5 minus 7 square is 0.7 plus I'm going to write the answer dulu lah, it's 5.887. Okay, plus with second one is 12 minus 7.9 square is 0.2 3.362. Third one is 0.1, sorry, 20 minus 7.9 square is 0.1. So it's 14.641. So we have here 23.89. Okay, this is the total total variance 23.89. And to find the standard deviation of S, stock S, simply square root of 23.89. 4.89%. Okay, so this is the standard deviation for stock S, this variance. Okay, we're going to need this variance later on. Okay, especially when we want to calculate the covariance. Okay. Any questions? If you have any queries, just let me know. So we move on now to variance. Okay, variance for stock M. Okay, we have the same weightage, 0.7. It's 40 minus the ER just now, 33.7 and 33.7 squared. Okay, plus 0.2, 25 is 33.7 squared plus 0.1, 7 minus 33.7 squared. So I have 783 plus 5 minus 33.7 square 2 in 1 8. And the last one, 7 minus 33.7 square. 71. It's 15.8. 27.2, sorry, 783. So I have 114.21. Again, to find the standard deviation for M, square root of 4.21. 10.69%. Okay, 10.69%. So as you can see here, if we compare the two between S and M, for the returns, obviously stock M will give you possibly higher returns. Okay, possibly higher returns. Okay, but obviously, if you take a look at the risk, okay, 4.89 versus 10.69, so obviously stock M will have or will bear higher risk. Okay, so higher risk and possibly to get higher returns. And for stock S, okay, bukan slide quite a lot in terms of lower risk, but with a lower returns. So what I've done so far, this is all for question number 1 to calculate the ER and also standard deviation for individual stocks. Okay, this would be question 1 ER, S and M, 7.9 versus 33.7. And the standard deviation is 4.9 versus 10.69. Okay, moving on to the second question. Okay, to calculate the covariance and the correlation. So first, we want to calculate the covariance between S and also M. Okay, the covariance. Okay, so again, for the covariance, we're going to use a quite similar formula like our variance, but okay, if you remember tadi formula dia is the weightage 0.7. Okay, multiply with the difference. Okay, the difference of stock A, which is stock S, meaning 5 minus 7.9. Second, 7.9. Okay, multiply with 40 minus 33.7. Okay, so this is the first difference. The one first difference. And this will be our second difference, this one, 40 minus 33.7. Okay, and remember for covariance, we don't use the square. Okay. If we have negative, just let it be. And as I said, by looking at the pattern, we know already this is a negative relationship. Okay, but anyway, we try to calculate later. So the second weight is 20%, 0.2. The second difference is 12 minus 7.9. Again, skip a second. It's 25 minus 33.7 plus 0.1. 27. 7 minus 33. Okay, so here I get negative 52.23. Okay, negative 52.23 covariance between stock S and M. So yes, we have a negative relationship between stock S and stock M. Okay, but the question also asks us to find correlation. Correlation S and M. Okay, and again, if you remember here tadi, the correlation. The formula is covariance divided by standard deviation A times standard deviation B. So meaning our covariance is negative 52.23 and we divide with standard deviation S was 4.69 4.89 4.89 multiplied with 10.69. Okay, you get a negative 0.999. So technically is I just use 1.0 lah sebab you akan dapat 0.999. There's a triple nine there, 15. So it's close to negative 1.0. Okay, if I use two decimal lah, I'm gonna get 0. Okay, so what does it mean? These two stocks have a very strong negative relationship. They move in a totally opposite direction between each other. Okay, so that's the correlation. So we have 6 marks for this covariance plus the correlation. Right? And finally, number 3. Okay, to find the ER of the portfolio. Okay, ER portfolio. So the weight is 40-60, 40-60, 40 6 AM and 60 ml. And we're going to use the ER of individual first. Is 7.9 and also 33.7. So it's 40% times 7.9 plus 60%, 33.7%. The average 6 times 33.7. So the average is 23.38%. So the expected returns of the portfolio, if I decided to split my investment into 40% in stock S and 60% in stock M, okay, my expected return from this portfolio will give me around 23.38% returns. Okay, as I said, I sacrifice instead of I put every money that I have in stock M, for example, which will give me average return of 33.7. I want to reduce my risks. I want to diversify my portfolio. So therefore, I put some of my money in stock S, 40% of it. So my average returns now is 23.38%. And by doing this, obviously, I'm going to reduce my risk. Okay, if you check your risk earlier, I have 10.69% for stock M. If I put all my money in stock M, I'm going to have 10.69% risk. But now, based on this portfolio, I'm going to find the variance for the portfolio. The first weight is 40%, so it's 40% square. Okay, 40% square. And variance of stock A was variance for stock S. 23.89, 23.89. Okay, so this is my first section. My variance is weight A square times with the variance of stock A. Okay, plus the second section will be weight B 0.6 square multiply with variance for stock B. Variance stock B was 114.21. Okay, 114.21. 4.21 is my variance for stock B. And my final section for my variance portfolio formula would be 2. Okay, it's always 2. Multiply with weight A, 0.4. Multiply with weight B, 0.6. And multiply with the covariance. Okay, and my covariance is negative here. So it's negative 52.23. Okay, so as a recap, this was the formula for covariance. Sorry, this formula. Okay, weight for stock A square times with the variance stock A, okay, plus weight for stock B squared times with the variance stock B, plus 2 times weight A times weight B, and times with the covariance. That's what we get here lah. Okay, so what happened to our variance? 0.4 squared times 23.89 plus 6 squared, so 1.21 square times. So I just write it here first lah. 3.8224 plus 6 square. 641. 6. The last one is 2 times 0.4 0.6 times and negative. So you got a minus 25,070. So 3.8224 plus 4156 is 25.0704. So I have a variance of 19.87. Okay, 19.87. And my standard deviation of portfolio would be square root of 19.87 4.46%. Okay, 4.46%. So by doing this, okay, I managed to reduce, okay, my risk, okay, from if I invest everything in stock M, okay, at 10.69% risk. By doing this portfolio, okay, I split my money into 2 shares. Okay, I managed to reduce my investment risk to just 4.46%. Okay, so that's what this portfolio tell us. Okay, whereby it gave us a reduction of risk. Okay, a reduction of risk with the respected amount of returns. Okay, imagine if I have 100,000 and I put all my money in stock A ataupun stock S in this case, stock S ni. I'm going to have a very minimal return, which is 7% saja. So I want to tap in these M stocks, okay, which will give me higher returns, 33.7% expected returns. However, with a higher risk, 10.69, I might lose my money, especially if the economy is going down at 7% return. Okay, but if I invest some of my investment in stock S, okay, whereby during the bad time, some of the stocks ataupun the 6 AM stocks ni will give me higher returns. Therefore, on average, okay, I might get this amount of returns based on this distribution of funds and with this reduction of risk. So therefore, I'm going to go with this. I will split my money in this manner. And therefore, I'm going to lower my risk and I can enjoy higher returns. Okay, higher returns as compared if I put all my money either in stock S or stock M individually, but as well as split and get a possibly higher returns with very minimal risk. Okay, so all of this will give you a total of 25 marks. Okay, kalau ikut soalan ni lah. So from here, question number 1, okay, you can capture ER 7.9, 33.7. Then my variance is 23.89 with 4.9 standard deviation. Stock B is 114.21 and 10.69 standard deviation. And my covariance is negative 52.23. And my correlation was negative 1. Okay, ER portfolio, 23.38%. The variance of portfolio is 19.87. And lastly, the standard deviation of portfolio, just square root of 19.87. I have 4.46%. Okay, just one more thing. With regards to the weight, okay, for this question, the weight is given, okay, 40/60. So I just use 0.4 and 0.6 respectively. Okay, but remember, this weight is based on the distribution of funds of your investment. So meaning, if the question doesn't provide you with this, you need to find first, okay, in terms of to find weight, to find the weights, find total value of stock A. Yeah, okay, total value of stock A. Second step, find the total value of stock B. Okay, step 3, find combined value. Okay, A plus B, so meaning A plus B. So step 4, find the respective weights. So meaning value stock A divided by total. And value of stock B divided by total. Okay, total yang step 3 ni lah. Okay, simple explanation. If my stock A is 25,000, my stock B is 75,000. So my combined 75 plus 25 is 100,000. So my weight for stock A would be 25,000 divided by 100,000, which is 25%. And for stock B, it would be 75,000 divided by total of 100,000. Okay, which is 75%. Okay, so this is how you find the weight yourself if the question doesn't provide you with these weights. Example lain tak? Okay, untuk soalan ni, for example, the weights, okay, they don't give you a straight weightage. Instead, they give you the value of stocks, but not the total values. Okay, not the total value. Like my example here, 25,000 ni, I give you total values. But in this case, the value is based on the number of shares with the price. So meaning you need to find the total values for stock A and stock B respectively by multiplying. You multiply the stocks, number of stocks times with the number value of the individual shares. For example, dalam case ni, stock A is 40,000 and each unit worth 4 ringgit. So 40,000 times 4 ringgit is 160 lah. Kan? Sorry. Okay, 160,000. Ini stock A, and for stock B, it would be 96,000 units with 250. So 240,000. So these are the values. So the same rules. So you have these respective values. Find the total. Total dia berapa ni? 3 point. Okay, I have to mute him. So the total 400,000. So from this, then you can find the weight respectively. So 160 divided by 400. So it's be 40% here. The other one, to just confirm, 240 divided by 400. So it'll be 60% here. So that's how you'll find the weights if they don't give you the weight individually like this. Okay, but instead, we need to calculate like this in order to find the values. Okay, questions? Right, so I think I will not go through the second topic ataupun the next topic yang I intend to do just now. So ada empat dah. So I'm gonna end our lessons today. So we have 3 more topics, so many. It means that we have 1 topic each to go sampai our 14 week. Right? So untuk topik ni risk and return, I'm gonna give you another quiz untuk soalan ni. So later on, please check your My Guru. Okay, check your My Guru for the question. I might not use this one. I might use another question. Okay, for you to answer this time around. This is quiz number berapa? Number 6 ke? 6 or 7? I can't remember. Anyway, please check on My Guru, and I will give you. Today is Monday. Okay, I will give you until Thursday. Okay, we'll give you until Thursday to answer this question, this type of question. I will post the question in My Guru later. Okay, so I will set the deadline until Thursday 6 p.m. Okay, but don't wait until Thursday baru nak buat and submit lah. Try to do it as early as possible. I will post the question just right after this. Okay, after I end our class, I'm gonna upload the question, and please try to answer the question in My Guru. All right. Any questions? Yeah. Okay, so if there's no other question, I'll stop here for today. So hopefully the video will be available for you to refer for the quiz later. And yeah, don't forget the deadline, this Thursday, 6 p.m. Okay, I recap, Thursday, 6 p.m. Okay, so don't wait until Thursday to do your quiz anyway. Okay, you have very ample time to do. Okay, don't wait until the last minute and blame, I don't know, internet connection not available on Thursday itself. So please be prepared, do early, right? So thank you, and inshallah see you guys next week.